entirely because of valuation. So the market is telling you loud and clear that the policy impact has come and gone.
Okay, well, let's get the reactions in then. Mr. Pradeep Kumar, coming to you first then, sir. How did you read the entire speech by the governor, and what do you think would be the trajectory going forward in terms of accommodative easing from the RBI?
The RBI has very clearly said what are the factors that will take into account before easing. And he has made it very clear the four things that the RBI will monitor. So I'm sure if 2 or 3 of them will go in the right direction, RBI will ease rates and maybe in the policy in October. And the other thing I would like to say, in the interview, he made it very clear what he means by transmission and what people like you understand. You expect when the RBI changes the repo rate by 25 basis points, you expect in the next second the banks change the repo rates by the base rate by 25. He very clearly said there is going to be a lag. And as far as banks are concerned, I think most banks have reduced already base rates by 30 basis points, which expects in 3 to 4 quarters. What has happened in January has already been transmitted. And I'm sure if the deposit rates, the cost of deposits falls down for the banks, the banks will have a relook at the base rates.
Mr. Pradeep Kumar, at the risk of sounding immodest, we do understand the lag effect of the rate cut. The governor also said that for further incremental rate cut, we need some more evidence of transmission. And do you think it's a bit of a catch-22 situation right now, where the banks are saying let the cost of deposit first come down, and the RBI governor is saying that let's see the transmission first?
If you see State Bank, we have been cutting deposit rates much before the repo rates were cut. We have been cutting deposit rates right from September, anticipating these rate cuts. But unfortunately, in a falling interest rate scenarios, I think retail depositors are also very smart. As they expect interest rates to fall, they move their money from CASA to term. And we have not been able to get a full benefit of the deposit rate cuts immediately. So I think over a period of time, when the deposits get repriced, the cost of deposits will come down, and we will be able to pass on with the reduced base rates to our borrowers.
Okay, well, for the Bank Nifty, we've recovered to a 0.5% gain. We have Lata joining in post the press conference again. Lata, over to you.
Well, it's not as if I got anything more. What the governor said was for all to see. And it looks like there is a small door of further rate cuts, provided the monsoons and the transmission and the spike in the June inflation continues or does not continue. So let me straight away toss to the economists then. Sonal, what did you pick up? The markets can hope for something more from the language of the text and the governor's speak?
Yeah, I think, Lata, clearly what we are seeing, if you compare this policy to the June policy, then June policy there was a cut, but the language was interpreted as more hawkish, given that they had highlighted the upside risk to 6% inflation, and this time around it was actually no action, but the guidance has been interpreted as dovish, partly because of the word that the RBI will be monitoring emerging room for more accommodation, as well as the risk to 6% now seeing as more balanced rather than upside. So yeah, that seems to have opened some room. Our own interpretation is that RBI is very much in a data dependent mode, and therefore I think one of the things that the RBI has highlighted in the document is that after 2 quarters of inflation expectations coming down, expectations have gone back to double digits. And also, while rural wages are moderating, corporate sales numbers are showing some incipient signs of pressure. So, obviously the big drop in commodity prices is a big positive for India in terms of overall bringing down cost pressures. At the same time, because expectations play a large role in in inflation formation, I think that is very crucial. And the battle around inflation and policy in India actually all boils down to inflation expectations. There's no doubt that for the current stage of business cycle, monetary policy stance is tight. But the issue is we need to see the low spot inflation translating into lower inflation expectations. And I think that going up is a bit of a worry.
Okay. No, you didn't answer my point. Are you seeing a door for a rate cut at all in 2015 itself?
Our base case is there's no further room for rate cuts, primarily because we don't see any incremental disinflation. I think last 5-6 months inflation's been stabilizing, and if the output gap gradually closes in the next 12 to 18 months, then there aren't really incremental drivers of disinflation. Except for the lower crude oil prices we have seen. So, you know, the particular wording in the policy statement does indicate that possibly there could be a room, but based on our economic projections, we don't see a cut actually.
Okay. Jahangir, same question to you. What should the markets take away in terms of further action?
Look, I mean, more or less the same point of view that Sonal has, that if you look at what he said in the press conference and also contained in the statement, monetary policy is looking at 3-4 quarters ahead. 3-4 quarters ahead, the relevant inflation target is 4%, not 6%. And we've been saying this for quite some time. You've heard me say it several times before. More importantly, if you look at not just this one, but the previous policy review, there is this wonderful red line where he puts out his projected inflation. He is already expecting August inflation to be at 4%. So if we really want room for further rate cuts, August inflation has to be below 4%. And more importantly, it should not spike up in September. So you need August inflation and September inflation both to be below 4%, which will come out in October. If the two of them hold together, perhaps there is a rate cut opening up somewhere in the fourth quarter. But again, I would say, even though RBI has tried its best not to bring this factor into play, the biggest factor is when does the Fed start hiking rates, and how disruptive or non-disruptive that might have on emerging market assets.
Okay. Well, I'm not done with this conversation. I'll just come back to you and Jayesh on the matter. But let me just ask the bankers what they have made. Mr. Murthy, when do you see transmission in terms of lending rate cuts? The statement seems to indicate that when credit growth picks up, bankers will be tempted to pass on. In your estimate, when does the next base rate cut come, if at all, in 2015?
Ma'am, I think we have seen it for ourselves in Bank of Baroda's case. There is already a base rate cut of 0.35 basis points, in fact, I think, compared to the...
I'm asking you for the next cuts.
Next cut is quickly happening because RBI governor is also very categorical, say that there is going to be a lag effect, and we are right now caught up with that peculiar situation, credit not going up, asset quality not improving, and then there is a cost of deposits have also come down as steeply as it has been projected, it has been perceived. The moment we see some difference in our costs coming down, I think we are definitely bound to pass it on because we are very important market player, and any cut in our base rate will only make us more competitive, in fact, when the real demand for credit goes up. Yeah.
Is it possible in August?
Yeah, possible.
Is it possible by September? By August?
I think before next policy announcement date, it should be possible, as far as we are concerned.
That's 45 days, September 29. Mr. Pradeep Kumar, same thing. What is the trajectory? When is the next base rate cut? Before September 29 or in August itself?
I don't think I'm in a position as comfortable as Murthy to predict when I'm going to cut my base rates. Yes, we are continuously looking at our cost of deposits or cost of funds. Whenever it shows a downward trajectory, we'll have a relook at the base rate. I don't think I'll be able to give a commitment whether it is before 29 September or afterwards.
Okay. Well, Jayesh, what have you taken away in terms of the way the 10-year might move, or the way in which the next cut, the bond markets will factor in further action?
I think bond market would look at next cut post the policy, post the Fed action. I think amongst all the 4 points, the biggest weightage would be given to how is the Fed action going to impact the emerging market, and we will have almost like 10 days for that to see the reaction in September. And if that passes through, and which looks like will pass through well, I think we do expect a rate cut in next policy itself on 29 September. In terms of bonds itself, I think bonds has kind of peaked out even before the policy. I just said maybe it might temporarily spike up to 783, 784. That's very, very temporary. I think a couple of things. A is your new supply factor, which will be down, and then of course the second half borrowing, and of course the FII limit, which again would be not before the next policy, looks like from the statement made. But at least there will be a constant supply of incremental FII limits coming in. With that, I think we have more or less peaked out on the bond yields for the time being.
Okay, just come again on the FII limit. You are not expecting it before September 29th, and I think he said once in 6 months it will change. So when are you expecting the limit?
Yeah, I think it will be linked to the outstanding something and maybe reviewed once in 6 months, or he also said maybe monthly. It will be reviewed once in 6 months, but maybe released once month. That's what they are going to plan out. But I think again the launching of that would be appropriate time. So appropriate time, maybe we'll still wait for the impact of Fed action, and that's why I'm assuming that it won't come before September.
I just want to point out what I got from it. He did not say it will be a percentage of outstanding. He said we will announce a limit, like probably 2,20,000 crore or something like that. So it looks like they're going with an absolute amount and not a percentage of outstanding. At least from the takeaways he said. There was no finality about the announcement, but there was no mention of percentage of outstanding. So it doesn't look like a moving number as much as a flat number, which will probably be reviewed every 6 months. That's the impression I got. So you see bond yields largely at 7.8 up until September 29?
Absolutely, maybe lower. But I think, what you are referring to rupee limit is to answer to the Q&A, but when he made his initial statement, he did say that it will be fraction of outstanding, So he did refer it as a fraction.
All right, I missed that, but we can check that with the Reserve Bank. Mr. Jain, now to you. Having got what the economists and the bankers are saying, what should the stock markets take from the policy at all? Non-event, done and dusted, and the markets are now back to looking at global factors and corporate earnings. No need to look back at the RBI till September 29?
More or less, I think that's the situation, because this is in line with expectations. The market wasn't expecting any rate cut at this point in time. But I think at least reading between the line is sounding more dovish than the earlier policy stance. So I think market is, the immediate reaction of the market was a little bit of correction, but bounced back. So market will look at other factors, and market will not be driven by monetary policy at this point in time, but would look at global cues as well as how corporate earnings and monsoon news come from here on.
Okay. And what therefore is your own stand in the markets? Are you seeing 8,550 or 8,600 kicking in as a roof for the markets now?
So underlying, even if you see just taking from the monetary policy as well, that growth is showing signs of picking up. So the macro environment is improving because the inflation is down and liquidity is benign. So regardless of rate cut or not, but if you see cost of funds is coming down across the sectors. And also we are seeing that there's a continuous flow of FI money will continue because China is no longer an attractive investment destination for whatever has happened, the way they handle large investors as well as the slowdown there. So all these factors put together, one can look at a scenario where there is a continuous flow of funds from FIs as well as domestic investors in the market, and coupled with some signs of recovery, corporate earnings may take a couple of quarters more to show some more visible signs of improvement, but all the factors point towards underlying bias for a bull market. But only thing which will keep market a little bit in check is the corporate earnings of this season are not very good. They are not very great, and therefore market has to, the corporate earnings, people who go by earnings and PE multiple will wait for some time. But still, at every decline, at every correction, you will find new set of buyers.
Okay. Well, finally, let me end with a question on which so much has been said and so much angst has been expressed. And that question actually is to you, Jahangir, first and perhaps only. What did you make of the emerging design of the Monetary Policy Committee and the governor's statement that, you know, he seemed okay with no veto. He said, veto is what I have now, and if the situation has to change, it should be a no veto. What is your reading of how will that committee design look?
Look, my sense is that, borrowing a term that he used in his monetary policy statement, it is definitely work in progress. I think we saw an unfortunate event unfolding with suggestions that, everyone now seems to be stepping away from. And my guess is that we will have a compromise. And it is very hard to see a monetary policy committee where the governor does not have, whether in terms of veto or veto-like power, and then be told that he is also responsible under the MOU to meet an inflation target. You can't have both. You can't say that the governor is accountable for meeting an inflation target and then say, well, he doesn't really have absolute power in deciding what to, how and when to use instruments. So my guess is that it has to, one of the two has to, I mean, if the compromise is that he doesn't have veto power or near veto power, then the MOU that they signed cannot really stand. So the government really has to choose between the two of them if that's the direction. My own sense is that that's not the direction that the government is going. Both the MOU and near veto power will probably exist with the governor.
So if there isn't a veto, or if there isn't a majority with RBI, you will think that FIIs will vote out of this market? Can that be taken big?
Yes and no, right? I mean, look, I mean, even before the FIIs react to it, obviously the FIIs would like an independent monetary policy committee with, a substantial amount of power with the RBI, given the fact that the RBI is now held accountable by a MOU. I think that inconsistency is probably what will, create, problems with FIIs, that you can't have the two together. So the governor will then be forced to choose one over the other. Which one will he choose? So I think that inconsistency is not desirable, and we should try and avoid having such, inconsistency between an MOU and the design of the Monetary Policy Committee.
Okay. Okay, I have to wind up. I mean, there isn't much that the policy has anyway given us. But let me throw one last question, which I did not get a chance to ask the governor because they ration out our chances, and even if you try to squeeze in 2 or 3 at a time, you get rationed out. So I just wanted to ask Mr. Pradeep Kumar, the governor highlighted the problem in steel. Power is another issue, but he highlighted the problem in steel. Do you think the massive problems of distressed steel companies will get resolved by growth, or some extraordinary extraneous step will have to be taken by government, banks and RBI to correct that problem, to correct the NPLs in steel?
See, there is obviously pressure on steel because of the steel prices, and this is because of international factors rather than domestic factors. But yes, all the steel companies have been affected, and because steel companies have affected, there is pressure on the asset quality in the banks. I think the answer in this lies mostly with the government. Government have to take certain initiatives like imposing certain duties, maybe government procurement, a preference for domestic steel and things like that. So the government has to come out with a set of initiatives for this steel sector so that the stress in the sector is considerably reduced. I think RBI has little to play in any of the sectoral issues. Of course, in power, we'll have to set right the position in the discoms.
Okay.
a long-term solution has to
Have
be
you been
worked out.
told,
The government is
Mr. Pradeep Kumar, what you're expecting from the government is only a reduction in increase in tariffs or something more than that?
See, there's a discussion going on. It is very difficult to say what to expect at this point of time. Too speculative to say anything at this point of time. What is going to happen?
Okay, Mr. Murthy, your thoughts? Does steel get resolved with growth, or should the government have to step in, or bankers?
I have a feeling, but steel is an important element of growth process, madam. In fact, I think what we are having at this point of time is there is no demand for the steel. Even if there is demand, the imported steel is costing cheaper, and I think these guys are finding it difficult to push through their products. Unless government comes out, RBI comes out with the relief measures, and banks also walk into that if attitude with some hand-holding of genuine cases, and simultaneously deal with those willful defaulters who have diverted with iron hand. I think the situation has to improve over a period of time. That's it. It has got to be a comprehensive approach, no one or two solutions, but it will be a comprehensive package of solutions which will work at this point of time to obviate the difficulties of this sector.
Yeah.
Yeah.
All right. One is looking forward to that. That was what was, I would consider, an absent paragraph in both the policy statement as well as in the press conference. Sonal, Jahangir, Jayesh, Nirmal, Mr. Pradeep Kumar and Mr. Murthy, thank you very much for joining me. Over to you, Anuj.
All right, Lata. Thanks a lot for that. Actually, before Nirmal goes, I just have a couple of questions for him if he's still listening in. Nirmal, you did say that the market will now focus on other issues. The policy is out of the way. What's your own stance on the market? Because we've seen quite a bit of volatility, and there's a bit of a resistance every time the Nifty is going towards 8600.
So market will consolidate at these levels, but in my view, underlying bias is positive and market is headed upward if you look at least next 1 or 2 years time horizon. It's almost impossible to predict market on a day-to-day basis, but market is showing tremendous strength. Even if you look at today's market, despite, of course, there are two schools of thoughts, and there was Moody's and also expecting that there could be a rate cut, but there was no rate cut and market has taken it in its stride. So that shows that market has underlying strength. There's a flow of money from foreign investors as well as domestic. So that's what my view on the market is.
Okay, so let's talk about a couple of sectors, Nirmal. How are you playing this PSU bank rally that's continuing even today? It's, the index itself is up some 13-14% in last 4 days. Is the risk reward still favorable here, or do you think this is a bit of a trading pop which could disappear soon?
I think PSU banks were beaten down to valuations which were quite absurd and very low. So some of the PSU banks were at 0.2 time book, some of the PSU banks were at 1.2 time operating profit kind of thing. So one has to be cautious because the NPA situation in PSU banks will not be standard across the board. Different banks have different kind of problems. But I think that the market always is sentiment driven, and when there was NPA scare, the pendulum swung to the other extreme and they were beaten down to levels which were very, very low. So I think there are some value seekers, there are some investors who are seeing tremendous value in this bounce back. All said and done, PSU banks in India are unlikely to default. There's an implicit de facto sort of guarantee by Government of India. And in that framework, if you see that some of the PSU banks are doing well, incrementally they are not facing any pressure to take up large projects where risk is higher. And if they keep the past problems in check, and some of them will get better with the economy recovering, and incrementally if they make sure that the book is of good quality, then over 6 to 12 months when there's a broader recovery in the market and the economy, I think they look good. So I would say that some of the PSU banks are still very attractively valued, and that is what investors are now chasing.
Okay. Nirmal, if we are discussing further triggers for the market at this point, in terms of any sort of further movement from the RBI and from a credit policy standpoint, how much of an incremental trigger would it be, and which would be the key event that you would be watching out for most closely, at least in the medium term?
So I would look at progress of monsoon, I'll look at corporate earnings, we'll also look at how parliament functions and if government is able to get through to some of the reforms and some of the bills that have been pending. and how's the progress on other broader reforms which include FDI policy, GST, and the tax reform. So maybe this is unless something unexpected happens on global front, maybe next few months one has to wait and wait for the busy season, and probably one can look at rate cut in the month of September also. So at this point in time, these are the factors that I would be watching closely.
Okay.
And this is again a market where people look at bottom-up stock ideas. So if the government orders are to a particular sector and particular companies are doing something which is good in terms of corporate earnings or products, those kind of ideas also people look for.
Okay, Nirmal, that was my last question actually. It's been a bottom-up market all through this year. The Nifty hasn't done much, but we've seen big gains in the junior, in the individual mid-cap stocks. For the Nifty to go back to all-time highs, what do you think would be the most important trigger?
So I think the banking stocks and the results, I think they will be one of the, because banks are one of larger sector, and PSU and private banks both put together constitute significant part of Nifty. So that has to lead. And other than that, I think some of the larger stocks in pharma as well as IT and cyclicals, there also one will be watching them very closely. I think for Nifty to go back to all-time high, the large cap stocks have to lead the rally.
How would you approach a lot of these global commodity plays or stocks which would be linked to what's happening on the global commodity cycle, barring the other kind of news flow? Say, for example, a Care in India, which is impacted by Brent crude prices, the likes of Tata Steel, Hindalco. Would you stay away from them?
I would stay away from them because the outlook for global commodity prices is still not very good. China is slowing down. The recovery is muted in anywhere else in the world. So in this kind of world, I think commodity prices are likely to remain soft. We all know that there is excess capacity world over for most of the larger commodities, and therefore in this I think commodities have still a long time to go before they recover and look positive. So all the companies that are linked to global commodities, I would be cautious on them.
Okay, Nirmal, a word on auto stocks. We've seen Maruti continuously hit lifetime highs. We've seen quite a bit of correction in Tata Motors. Today you've seen, Hero MotoCorp actually seeing a bit of a bounce back after the numbers. Is there anything that you like in this space in terms of risk reward? What's the better stocks among all the ones that I spoke about?
I think I like Maruti and Tata Motors in that order. Maruti is, I think car sales in last 4 months have not gone up significantly, and there's huge potential for penetration to improve, and particularly in smaller towns and rural areas, and Maruti is very well placed there. Followed by Tata Motors, where we are seeing revival in heavy commercial vehicles. But as far as Tata's international operations are concerned, there's always a worry about China, whether there will be a demand for Jaguar or they can slow down significantly. But on the whole, I think Maruti and Tata Motors, they are two good companies in this sector.
Okay, well, we didn't address the Britannia numbers that came through while the credit policy was on, and it's a strong EBITDA beat which has come in on Britannia's numbers. In fact, it's up 70% on a year-on-year basis versus estimates of around 40-odd%. The stock, in fact, building on to those gains, which has already been quite strong in the past 12 months. Nirmal, last word from you with regards to the likes of these FMCG or defensive stocks. Say FMCG/pharmaceuticals. The likes of pharmaceuticals have disappointed this quarter largely in terms of numbers. Which one would you prefer between FMCG and pharma, and why?
I think one has to go by stocks. So if you look at FMCG sector, then it's quite richly valued. So if market has a strong rally, then this sector will underperform. But on the other hand, if there's any negative event and market has to correct, or market does not perform well, then this sector performs better than the market. Most of the companies here will have 15 to 20% growth. Again, companies like Britannia, they are announcing good results, maybe preferred over companies where results have been subdued like ITC in the large cap. But between the two sectors, I think in pharma, I would go by picking up specific stocks, because this is one sector which is quite heterogeneous in terms of its performance. most of the companies have different product categories, different markets, and different strategies also. So you just can't paint them with one brush. Relatively, FMCG sector also has certain verticals, I mean certain segments, but within the segments there are companies that perform more or less in line. So at this point in time, I'll go by bottom-up stock picking rather than choosing one sector or another.
Okay, Nirmal, we're going to leave it on that note. Thanks very much for joining in and talking to us. Well, that is what is coming in some fundamental perspective. And for the markets post the credit policy, the reaction, you'd have to say, has been quite choppy. The Bank Nifty is still trying to negotiate, make up its mind on whether it wants to go up